Hi, welcome to another episode of Unlocking Medicare with your host, Tyrone Carr. Today, our special guest is Andrew, CEO. He's one of our partners, and Andrew works on the P&C side of our agency, and so he specializes in home and auto, business insurance, workers' comp liability, and umbrella policies. And what we've seen over the last couple of years, there's a lot of questions our clients are asking pertaining to the Auto Reform Act. How does that impact Medicare? How does it impact your policies? What should I do? You know, you're hearing people saying, I don't need the healthcare coverage on my auto policy. And so what we want to provide for our clients is, education. Mm-hmm. And again, that's our emphasis every single week, education, education, education. So being that this is such an important part of Medicare, and most certainly making certain that you have the proper coverage when it comes to your auto policy, homeowners insurance, help us, Andrew, to better understand what the Auto Reform Act, what it's done, what we should be cautious of, or what we should be doing or shouldn't be doing.
Yeah, absolutely. So thanks for having me on, first and foremost. Auto reform provided an opportunity for choice. So choice is often good, but if you leave people with choice, they can make mistakes. Probably no different than your world in the Medicare space, where you've got a lot of carriers, a lot of plans, a lot of combination of plans, and every client is in a different position, right? What they take for prescriptions, how often they're going to the doctors, what income they're at, where the heck they live, right? All those things, no different than in the property casualty space. So about 2 years ago, just shy of it, auto reform came about, gave some choice, especially those in that space of Medicare eligible or Medicaid eligible, where they can choose a reduced amount. Obviously, there's some costs that have come down within the plans, right, per vehicle per year. And then you throw in this new thing with actually some refunds coming out of that, the $400 per vehicle, and that's all great. I would say more has stayed the same than has changed. And we find that once we kind of talk through people's plans, right? There's been comfort with the way auto has been in place for the last 40, 50 years, because it's unlimited coverage, right? There's comfort there that if the worst day happens, I know that I'm going to have my medical bills taken care of. I know I'm going to have therapy bills taken care of. I know that remodeling of my home and other things that I might need is all going to be taken care of. There are, I'd say, fewer instances where someone chooses a reduction in coverage, but there are those right fits. And I think that just as you do education on a regular basis with your clients and through these podcasts and webinars, every time we get the opportunity, we'll educate clients and try to understand and listen where they're at, what are their fears, what are their goals, what are the assets and so forth in place that we need to protect. And ultimately, that's what helps us create our recommendations. And at the end of the day, client makes the choice on what's right for them, their spouse, their family, their estate, their heirs. So that's a part of it. There's a lot that's gone wrong in the background, little pieces when it comes to the billing, things that you and I wouldn't see or that none of our clients would see on a daily basis. But there's a lot that has come about, some confusion, but we try to clarify that as best we can with clients and get those right policies right each time.
So with the Auto Reform Act, if you have someone that is contemplating making changes, what are the questions you would suggest a client or a prospective client they should be asking pertaining to the Auto Reform Act?
Absolutely. So I would say a lot of the questions we ask haven't changed. They've been the same for as long as I've been in the business, and it's really understanding, hey, do you have active income? Do you have passive income? What is the kind of the portfolio or the overall financial picture look like? Maybe they're already in retirement, and what does that look like? Because at the end of the day, the sole reason why you have insurance is to protect assets, right? Is to protect against that worst day. If there's a lawsuit, you cause a claim, there's a claim against you, and how do we get those bills paid? Right? So you can self-insure it, or you can lean on an insurance company to pay them. If someone is very financially comfortable and they are in retirement, I always say I never want that client to take a step backwards in life. And you can increase the odds of that not happening by increasing the coverages, right? Probably maintaining unlimited, when it comes to the MCCA, the PIP coverage. Probably maintaining a higher level of liability coverage in those bodily injury and the un and underinsurance categories, and or tacking on an umbrella policy that helps, again, create a larger barrier of entry so that, again, whether you cause an accident or one's caused against you, you have the protections in place. So very similar, very parallel conversation from what we had before. And so to answer your question more precisely, I'd say, review maybe those sections of the policy, the bodily injury, the un and underinsurance, again, what coverage and deductibles are in that MCCA or PIP category, as well as the personal liability, which is on the home side of things, and really get a whole financial assessment. I mean, when we talk about increasing the liability limits, you might be talking $5 to $10 a month to bolster, the protection by hundreds of thousands of dollars. Or in some cases, we're saving them money and increasing coverages, so it's the best of both worlds.
Is there a difference between the Auto Reform Act and how that's affected a personal lines policy versus somebody who has a commercial?
Yeah, so I mean, both have the responsibility of protecting their assets, right? So you've got the personal, right? You have an auto policy, I have an auto policy. It's our financial picture. On the commercial side, you still have choice and coordination, the refund. So again, probably a lot more that's the same than different. The only difference I would say is, right, oftentimes when we deal with business owners, they might have, their business incorporated or in an LLC. So there is at least one extra layer versus a personal auto policy where it's in yours or your spouse's name. So that's a good help, but oftentimes if there's a good lawyer there, in a commercial setting, if someone's getting in an accident in a commercial vehicle, they're probably trying to wrap their hands around, the owner personally, the business professionally, to reap what they can for their client.
On the Medicare side of it, we have various different types of policies, the Advantage, the Medigap policies, and so although they're both good policies, and you got to make certain that the person you're speaking to or of, and based on their circumstances, we may suggest one particular policy over another depending on the circumstances. Is there a case when it comes to the Auto Reform Act that you would suggest, making changes to their PIP, or is it always appropriate to have, unlimited coverage versus somebody that may have lesser coverage?
That's a great question, and it's probably one of the harder ones we get asked, because I never know if you're going to get in an accident. I never know if you're going to have a claim, and I never know if it's going to be severe, and I never know if there's going to be other parties involved. That's why insurance is the way it is. That's why carriers are able to, because they collect premium a little bit from everybody and pay out probably large sums for the few that have those severe instances. So, there's no perfect algorithm, there's no perfect equation that says you make this, you have this, you own this, therefore you should do this. I would say that if the difference of $5 to $10 does not make or break somebody, then we probably want to talk about maintaining, maybe the $250,000 or $500,000, or hopefully the unlimited coverage. But we do have some clients that have been on tougher times, right? The last 2 years has been that to some. And if it's the difference of putting food on your table, then, right, we have to make some of those decisions. And ultimately, if there is a lawsuit, there may not be those assets to reap benefit from if someone came against them. So, I would say at first blush, if I had to broad brushstroke and make a recommendation, it would be to, maintain unlimited or a very high number to protect yourself if there's medical bills, or protect others protect yourself from others in a lawsuit. But ultimately, hey, we have to live, right? You got to put gas in your tank. You got to put food on the table. I got to pay heating and cooling bills, especially as we venture into hopefully some warmer weather here in Michigan. So, again, case by case basis, but that's probably where most of the conversations lean. So,
we hear about in the news. I've read articles, with the Auto Reform Act, and people have had a close head injury, and the state's paying for that. How is that affecting people, and what can they do? Because I know people are like, oh, Medicare is going to cover the injury in the event of an auto accident, but we know that from a nursing home, assisted living, respite care, custodial care, private duty care, that Medicare doesn't cover that.
Oh, absolutely.
So we're very limited. So is that where where the unlimited coverage comes into play?
Absolutely, yeah. I think there's at first blush you think of the unlimited, and auto reform to be the medical bills, and that it can be, but it's all the other things, right? It can be the transportation, it can be the physical or mental therapy that's involved, it can be the modifications of homes, right? Widening doorways, putting in handles in the shower and making them kind of a zero entry. All of those things that are outside of just getting a bill from being in a medical bed or being in a hospital for a period of time. So you're right. It's making sure that Medicare and auto insurance is coordinated, and in most cases, or all cases, right, auto reform is, well, they're trying to make sure that the right party is paying. Yeah. And so auto reform should be primary in those instances. Same thing if someone maybe even retired earlier and they have individual health insurance, auto should be primary. But again, even if it is relying on a group medical or something of that nature, it is for the hospitalization, right? It's for the prescription drugs, it's for medical services, not all the ancillary things that can come up.
Yeah, it's, during our seminar we had this morning for Medicare, the emphasis that I always point out is people just can assume that Medicare is going to cover all the private duty, the custodial care, the respite care, someone to come in and take care of you if you can't feed yourself. And so, which remind them, this is not something that Medicare is responsible for. It's very limited. And what coverage you are provided is, there's certain contingencies or steps that have to happen, or certain things have to fall in certain alignments to make certain that they will cover. And you have to be on top of that. Otherwise, Medicare is not going to cover it. If you have a Medigap policy, they're still only going to cover, if everything's in alignment, it's only going to cover you up to 100 days. After that, you're self-insuring. So, again, I think with the Auto Reform Act, there was that notion that, okay, if I don't have this, Medicare is going to cover it. And the Medicare benefits didn't change just because the Auto Reform Act was put into place. So, with that, one of the questions I have, we're in some different times than we were just, a year ago, 2, 3, 4, 5 years ago, and seeing that we're seeing homes, the cost of homes being inflated. And so for various number of reasons, when it comes to someone that purchased a home and it was insured, let's say 5 years ago at $500,000, and I know my home, for example, has gone up, close to $300,000 in value just in the last 2 years. So knowing that I want to make certain that my house, in the event that there is a natural disaster, a tornado, a fire, something like that, that if something does happen, what are something that clients or prospective clients you would tell, this is what you should look at your policy, and this is what you should see if it needs to be reevaluated?
Yeah. So I'd say number one, review your policies, right? If you put something in place 5 years ago, 10 years ago, we sit down with clients that started a policy 30 years ago, they haven't moved, they haven't had reviews with their agent, and it's been somewhat stagnant. Sometimes policies will have a little bit of an inflation guard built in where it creeps up 1 or 2%, but like you alluded, these are tremendously different times, right? Inflation of everything from, wages that we pay, the material costs, right? The supply chain, and we kind of had a little banter about that with some, office furniture. Everything has changed. So review, make sure it's current. Make sure your agent is doing some sort of financial analysis on the building. So you mentioned that the value of your house has increased, which is fantastic. There's a slight difference in our world versus the real estate world where, hey, the house might sell for a different value than what it costs us to rebuild it. They're often in stride, but right in a time of recession, it's inverse, right? Well, yeah, the house you couldn't sell for a fraction of what you could the year before, but yet it costs us the same to rebuild it. Vice versa, the real estate market might be really hot right now. Maybe it costs us a little less, but right now with inflation, they're pretty much in stride. So we have access to third-party systems that we can enter in data, square footage, ceiling heights, number of fans, sunrooms, pools, attached, detached garages, 3-car, all the details, right? Finishings of floorings and bathrooms and semi-customness. We can plug it in there and it gives us an estimate on the material and labor costs so that number increases as well. So I would say, number one, review with someone who knows what they're doing. In addition, there are riders or endorsements on policies. So you've got this coverage A, the dwelling amount, that's everything that we just discussed. Then there's these endorsements where you can increase that coverage incrementally. So there's maybe an extended replacement cost. So not only are you getting that entire amount, but maybe you're getting a 20 or 25 or 50% buffer. Right? So your $500,000 house, now without doing anything more, if it has 150% of replacement cost, now if we never reviewed, we never talked about inflation, you've got $750,000 of coverage. Or even above and beyond those items is a guaranteed replacement cost, which means, hey, the agent, the carrier, they've done their due diligence, they believe that this is the replacement cost, and if any variance occurs, right, because we didn't review, because there was inflation that got out of hand, whatever, you're going to be guaranteed that that is going to be rebuilt the way it was. So I'd say those would be my recommendations. Review, talk about coverages, look at that reconstruction cost assessment, and maybe throw on some endorsements just so you have that kind of, comfort that it's going to be taken care of no matter what.
Yeah, I would say, I know we had brought in a client, and I think one of our agents had, it was Lauren or Josh, and I remember vividly her concern was, I thought she was a real estate agent, and looking at what her coverages were at the time versus what, the cost to build something today was up like 30%. And she was pretty certain that she didn't have enough coverage, and that ended up being the case. And thankfully we were, one, she knew what to look for somewhat, and be in the real estate business, but not everybody does. And so that, sparked the question, and she actually was referred to us by a doctor friend, and so that was, where she was really grateful that we were able to educate her on that, even though she had some level of education.
Absolutely. And I'll share with you a quick horror story. It didn't come from our office. It didn't come from one of our clients, but others in the industry that we know. And unfortunately, they got in a situation where, there was not a review. The market kind of went the way it has gone the last couple of years, and they had an entire home loss. And that disparity between what the coverages were on paper and what it's actually going to cost to rebuild was a $400,000 delta. So you have insurance maybe for the first couple $100,000, first $500,000. But now when we talk about, where does that $400,000 come from, right? Can we get a loan to rebuild that? Or are you paying cash out of pocket? Or are you going to deplete either future investments or current or opportunity cost that's lost? I mean, all the different ways that could have been taken care of for maybe a few more bucks a month on the insurance.
So what happened? What was that?
I'm not involved in that situation. I just kind of heard about it through. But ultimately, they have to decide how they're going to personally finance an extra $400,000. What I've heard, unfortunately, is that that's going to be the difference of, whether or not the daughter has to take out a loan for college or it having been paid for. And unfortunately, the guilt, I think, is on the daughter because it was started from a hair curler or curling iron that was left plugged in.
So is there any responsibility or liability on the agent? So if we were to write a policy and that, for example, it was only insured at 100% versus 100, I mean, is there any repercussion as far as on the agent that they're liable? So what would you suggest, viewers or a client or somebody, if they were put in that situation, what would you suggest or recommend them do?
Yeah, so, short answer is yes, there's always responsibility from, the advisor in any way. Ultimately, that's why, for the client's sake and for our sakes, we ask for a review. Could be a form to do a quick review once a year. Could be even if it's a 15 to 20 minute meeting to say, hey, Tyrone, have you remodeled anything? Have you done the basement? Have you put on an addition? Or hey, heck, have the numbers just not been updated? So yes, there's responsibility from the agent's perspective. There's also responsibility as us as homeowners, right, to relay those things when we can, be proactive or be responsive when an office calls to set up reviews, or you get a mail or an email for a little bit of a quick review form. And that's a way to keep in touch. It's a way to ask some questions and get some answered. But at the end of the day, agents have to have, or should have, basically a malpractice policy in place, an errors and omission, just like a doctor would have if they made had an issue on the surgery table, if we have an issue, we ultimately carry an insurance policy to back us up. So, the hope is that, knock on wood, we never have to flex that because we do the right things by clients and we do the right things proactively for clients. But at the end of the day, in that circumstance, what ultimately might happen is a little bit of an errors and omission claim from that agent if that policy was not written properly or was not reviewed, and if they can point it back to them being the causal issue.
Oh, that's great. So, first of all, again, thank you for coming on today. It's very informative. And one of the things I would say to our listeners, viewers, one of the things that I love about you, having you as a partner in all this, is your area of focus and your knowledge and expertise and the P&C side of things. And I know I can always count on you, and I know clients just rave about what you do and our entire team as far as that provide education, back office and stuff. So I can't tell you how much I appreciate you. And to our viewers, thank you again for watching another episode of Unlocking Medicare. And thank you to Andrew, CEO. Yes, that is his actually last name. I think it's the coolest last name, CEO. And so if you want to have a quote or have us review any of your home or your auto policies, or if you own a business, commercial umbrella, please reach out to us via phone, email, and we'll get you in touch with Andrew or any of our agents. Look forward to our upcoming episodes. Next week, we will have a special guest, an elder law attorney, Sam Lebowski. Again, we'll talk to you soon. Thanks. Thank you for checking our podcast today. We appreciate you. And please check out our website where we have future dates and times for our Medicare 101 seminars throughout the Metro Detroit area. So please check us out. Come meet us in person. Look forward to meeting you in person. And again, tune into our next week's podcast as we dive deeper into Medicare. Thank you. Have a great day.